So I would like to now invite Vikram to come and speak about startup valuations, which is, I think, a concern for everyone here. All of you have lots of questions around valuations. And Vikram has probably had some of the best exits in the last 1 year while the country was, and the world was facing the COVID, I would call it a terror. And he's had some amazing time in terms of having exits as well as also investing. So while people were refraining from investing, Vikram was happily making investments. And over a little conversation that we had a few days ago, or rather I think last week, we learned that it was an amazing time for him also, very busy, because there were a lot of probably good deals around. So, like we all go shopping, I'm sure investors all go shopping. Yeah, am I right?
Yeah.
So, it's never a bad time. Like in the stock market, they say it's never a bad time, right? I mean, whether the market is low or it's high, if you're a good investor, you know what to do. Right? So here we have someone who's, done it both ways. And I would now request him to please come up and share his vast experience and knowledge investing in this startup world.
Thanks, Gaurav. Thanks a lot for that kind introduction. So it's a pleasure to be here. This is my first time actually in Guwahati. I've always been looking forward to visit Guwahati, so it really feels great. So thanks a lot for inviting me here, Gaurav. And I'm also excited to interact with each one of you over the next 2 days. I'm actually here today and tomorrow, so I'd love to interact with as many people as possible. So let me quickly give you the background in terms of what we do, and then maybe I would like to also make it very interactive. So I'm sure you guys have lots of questions in your minds in terms of, and since we're talking specifically about valuation, so I think that's kind of it's a very, very interesting topic. So I'm sure there are questions in your minds. So very happy to understand what those questions are in your minds. So IVCAP Ventures, we started in 2011 with the very different idea. So actually, we initially brought together the entire IIT alumni ecosystem on a single platform, and then added the IIM alumni as well. The alumni trust, which brings in the alumni capital into that trust, becomes the anchor investor for the fund. So we've actually raised 2 funds already deployed fully. We are currently in the process of closing a 3rd fund. First fund was about 240 crores, second fund was about 535 crores, the 3rd fund is about 1500 crores. We're just in the process of closing that right now. We actually invest right from seed stages, about 1 crore, go all the way up to 40-50 crores as a first check, and then we follow on. So as our companies start scaling up, we put in more capital. We invest up to 100 crores as a follow-on capital. The companies that start scaling up further. But we believe that, like you might have heard of this Tata Steel thing, that we also sell steel. So it's the same thing, we also give funds. So actually in our case, funding is only one of the things that we offer. So for us, what is more important than funding is working very closely with the entrepreneurs, with a lot of hand-holding, supporting them with as much mentorship, guidance, support that we can provide. So we have a separate platform called IV Camp as a platform for engaging the startups and helping them even find customers, mentors, investors on the platform. And there are quite a few incubation centers, IITs themselves, IIMs on the platform. Then we have a mentoring platform where we have core 65 mentors and about 5,000 alumni get engaged which then have access to the entire 500,000 alumni in the ecosystem, and therefore we can bring all kind of support to our startups that irrespective of whether we invest in them or not, we try to give them support, and over a period of time, as the engagement increases further, we then identify which are the startups that we should invest in. In fact, we help them even find corporate partners and other things. So that's how we operate. We also have started very recently very, very specific focus for SDG. With the Fund 3, where we have a lot of SDG orientation. We have, in fact, I've got Smita is going to be here today. She runs a company called Fendoro, which actually does SDG consulting. So we actually recently acquired Fendoro as a entire business and the team to help map our own companies, understand what SDG is and map their business out various goals on the SDG framework. So we believe that, in fact, one of the fundamental questions that people have is, impact versus returns. And there's a big debate of, when you focus on impact, does that mean you're compromising on returns and vice versa? We believe very strongly that following an SDG framework actually enhances your returns. So effectively, if you actually become very organized, disciplined, in following the SDG framework, and you're serious about it, with the specific metric that you map yourself on and track yourself on, your returns actually go up. So I think with that philosophy, we've actually integrated the SDG framework into investment philosophy. Now, coming to the topic, I think it's important, and I think I would love to first understand the audience here. So, how many startups are here? Who are all the startups here? Just can you raise your hands? So, got it. Okay. So, and how many are local here in Guwahati? How many are local Guwahati? Okay, got it. And how many are outside of Guwahati? Got it. How many of you have raised any money so far? Any professional money? Okay, that's great. Anybody has raised like a Series A fund so far? Nobody's raised Series A. So most of you, I assume, have raised seed funding so far. Whoever has raised funds. And when you raise your seed fund, have you raised from like professional angel investors, or is this friends and family? CIO is it? Yeah. So there, the good news is that I think India is, as we all know, I think it's amazing. The kind of last like 1.5 years or 2 years now has been amazing for India. Well, globally, COVID has of course impacted otherwise, but I think it has been really, really amazing for the startup ecosystem in the country. From various perspectives. One is that entire digitization has helped or has happened much faster than people had expected. Second is that because of the China backlash, a lot of global capital, which was earlier going to China, is now coming to India, because of which there is a huge amount of capital available in India. And there are pluses and minuses of that happening. Of course, the pluses are that you see large number of investors. You also see large number of exits happening. Therefore, the people who are exiting, they are making more money. When they're making more money, they want to put that money back into the startup ecosystem. So there are number of investors increasing quite substantially. And the capital is coming across different stages, right? So majority of the capital is coming in later stages. Right? So if you see Series B, Series C, $50 million checks, $100 million checks, that has increased substantially. But that has a trickle-down effect. The people who are making money at that stage, now whatever money they're making, whether through ESOPs or maybe some small exits they're having, they actually are using that capital to start making seed stage investments, which is excellent actually. So I think the data which I have seen or heard is like about 60,000 DPI registered startups in the country today. About 25,000 of them have been angel or seed funded so far. Only about 800 to 900 are Series A funded. So it's okay if you're not Series A funded yet, right? So I think, but good news is that, there is a lot of funding coming your way. So you guys need to understand and learn how to really raise your next round of funding. So a lot of the valuation story is actually linked to how you position yourself, how you plan your next phase of growth, what kinds of investors you deal with, and what kind of team you are. So there's a story which has various components of the story, and this all boils down into a business plan, right? So the business plan is a justification of, you have the historical perspective of what you've done so far, and you have a future. Of course, if you're a startup at the seed stage, there's not too much history. So it's all story. It's 99% story or 99.9% story. So therefore, the art lies in how you tell your story. So I think, and I can relate to my own story when I started Ivy Cap. And this is something very interesting. When I started Ivy Cap, I was just like a single person, one-man army. And typically you may not have heard of venture capital funds starting with zero capital. So in my case, for example, I had zero bank balance. I had to borrow money to survive myself for 6 months, and then ended up setting up a venture capital fund. The first fund at 240 crores. So it was all story, basically. So when I started raising a fund, imagine going to an investor and telling them you'll be investing in a blind pool. A venture capital fund is actually a blind pool, which means that they have no clue where the money is actually going to go. So which means I will be deciding. I will not be asking them where the money will go. And then, if the startups that I invest in do well, great, I will take a profit share in that, 20%. And if they don't do well, if everything becomes zero, sorry, basically. So that's the story, right? So actually at the bottom line of that's the story, right? So imagine selling a story like that to investors and still raising capital. So it's all about how you tell your story. So therefore I think you need to be very, very clear about what you're communicating to your investors, right? So valuation actually is an outcome of the belief that the investors put in your story, right? And your story is about a lot of components, right? The first thing in your story is the team. When you talk to an investor, you're basically presenting a team. And the team itself has its own credibility, its own background, its own trustworthiness, and lots of factors that go into it. And then the story is also about, solving a business problem, or solving a problem which, the team believes hasn't been solved the way it should have been solved. And so therefore there's a lot of aspects on the differentiation, why you are different, and how others are solving the story. So of course, beyond that is, showing your future plan, your projections, how you're actually going to do your revenues, what costs are going to go into it, and the believability of those projections, right? So a lot of your maturity comes through how you communicate those numbers, how you've done those numbers. Your maturity level comes out from the way you've done your projections, right? So if you're saying that I'm going to price my product at a certain level, and if you haven't done your research enough to be able to justify that price, the investors will figure it out. So your maturity level comes out in terms of how much research you have done in understanding whether you can actually do certain price, what customers you are targeting and why you want to be different in that customer segment, right? So and then the cost, how you want to deliver, and what cost you want to incur. So all that gets translated into your business plan projection, and therefore the delta in terms of how much cash you will be needing, right? Because initially your cost will be much higher than what revenues you generate. Your team needs to be paid salaries. You may need to have at least some working space somewhere. You need to travel. You need to have communication, use telephones and a lot of other things. There's a lot of cost initially, and there may be zero revenues in the beginning, right? So until you start making revenues, all these costs, where is that money going to come from, right? So typically you will raise that from your friends and family, and you put your own capital, and then the revenues, you see the side of the revenue, and the revenue is a justification of, what you're doing is actually validation of your entire story. That look, the customers are paying, and look, I said the customer is going to pay this price, they are paying this price. So when you start looking at that progress, you see that your cash flows start showing, right? So your cash flows are basically, will determine or will reflect the margin structure of your product or service, right? So the margin structure also reflects, in a high volume situation, how much you're actually going to make. Even though you're making losses today, like Flipkart or Ola or all these companies, Amazon, these companies have made losses for many, many years before they actually started making profits. But their valuations touched billion-dollar valuations even before they could justify profits, right? So many people have asked these questions, how can you justify valuations of $1 billion when you haven't even seen profits? So that's where you look into the details of where the profits are actually going to come from when you actually have larger volumes. And if your gross margins are significant enough to justify that, even if you incur costs in the beginning, over a period of time when you have more volumes, these gross margins can justify very good profits over a period of time, right? So, that's where the entire justification is around. So typically valuation, when I say it's a story about, what kinds of cash flows this business can generate over the life of the business. The life of the business is infinite, right? So actually the business can live for infinite number of years. So basically, even if you can show to an investor a 5 to 10 year picture and say that, well, in 5 years I see this picture where I'm turning profitable in 5 years, in 10 years, I'm actually generating these kind of profits. Now it's a matter of how these investors, align with your entire thought process. Therefore, you have to select the right investor. When you're actually going to make a pitch to an investor, if you're making a pitch to an angel investor who doesn't understand your sector at all, and whatever you tell the investor will not understand anything. So for that investor, the valuation, any valuation will not make sense. Whether it is a high or low, the investor will not understand anything. In fact, at the seed stage where most of you are, it's very hard to actually justify any valuation, right? So you may paint a picture of 10 years, and if it's all a story, you can go to an expert and say, hey, help me make a 10-year plan so that it looks very good. Looks like Amazon, and so that I can raise money at $1 billion valuation. People can do that, right? So then as an investor, how do I believe in that story, right? So it has to be, I don't even know, first of all, whether it's really your own story or somebody else has told you the story and therefore you come with that paper. And everything after that is like Excel spreadsheet, right? So you just change certain assumptions and everything else will change accordingly. So therefore, very hard for an investor to actually pinpoint that this is the valuation of your business at that stage, right? The numbers can change either way. So therefore, what investors do at that stage? Typically, a smart investor, of course, now there are examples and there are structures and there are standards which are available globally, and whether it is Bay Area or India, you will see that this has become a norm that typically when you are raising your first round from a professional investor, maybe an angel investor or maybe a seed investor or maybe a platform investor. So typically they will try to do it based on a safe note, as they call it. A safe note is something where they would not value your company today, but they think that your business can be valued very well over a period of time. They may have seen very similar businesses, who have certain valuations. There are benchmarks available But benchmarks are only available at Series A or Series B. So they will broadly know that maybe, at Series A you can be valued at $10 billion. If you do certain things in a certain way. Right? So what they may do, they would say that fine, I'm going to give you $200,000 or $500,000, subject to my valuation being at a 20% discount to your next round, provided that discount happens within 6 months, or that valuation happens within 6 months, or within 12 months. So they'll apply certain percentage numbers discount based on, and then they put a cap of the valuation that provided the valuation is not more than, if the valuation is more than a certain number, then of course their valuation can get capped at a certain number because they're coming before anybody else and they're taking that risk. So at that stage I might say that here is my $200,000. My valuation is 20% discount to the next round. And you may tell me that I'm already talking to certain VCs and I do believe that my next round can happen in 6 months. When you give me the money, I can start showing certain validation to those investors, and therefore my valuation should be at least $10 million. And if I believe that maybe, $5 million is the maximum I should go to, so I would say that I'll give you $200,000 subject to a 20% discount to the next round, subject to a maximum valuation of $5 million. So which means that if the actual valuation happens at $3 million, I'm still at a discount to that round. So my valuation is $240,000. You have taken a 20% discount to $3 million. If your valuation is at $10 million, I've still entered at $5 million because I've already given a cap, right? So this is a way the investors try to get an entry into the business because they like the team, they like what you're doing, they like your story, they just don't know how to value it. So they will define a number in such a way that they are safe. It's called safe note, right? So they want to be safe. So basically, that's the idea behind valuation at early stages. Many angels make a blunder at that stage. They don't know how to do valuation, but they love doing valuation. So they love just the negotiation of the valuation. They're just, okay, tell me how much take you're going to give. Right? So this is actually a very, for some people it gives them a kick. Like I put in 1 crore and I got 15% of the company. Right? So I own 15% of the company. So that's there. So this is mostly coming from investors who are not necessarily mature. Now, why they make a mistake, why do they blunder at that stage is because either they will overvalue the company or they will undervalue the company substantially, right? So what happens in both the cases? If they've overvalued the company, what happens is that if I've taken, let's say, 2% stake in a company at 5 crore, just as an example. So effectively I value the company at what, can anybody tell me? If I've taken 2% stake in a company at 5 crore investment, what's the valuation of the company? 250 crores. So effectively I valued the company at 250 crores at that stage so I've overvalued the company, right? Now what happens when I go to raise my next round? So now I've raised this money, 5 crores. My next round, I go to a VC investor and say, hey, I'm raising 30 crores, can you give me 30 crores? When I look at your history and say, hey, your last round was at 250 crores. I will say, your last round investor will ask for some upside. So effectively now you would ask me, give me at least 400 crore valuation. Your business won't justify at that stage. So effectively you will find it extremely hard to raise your next round when you end up raising your seed capital to such a high valuation. Now what happens when you are actually undervaluing yourself, right? So if you raise, let's say 2 crores and you own, let's say 20% of the company. So, effectively you've given 20% of a stake, at 10 crores valuation. Now when a Series A investor comes, and this typically happens when another investor sees that, wow, the 10 crore valuation, this company is available, they'll give you another 2 crores, one more guy will come and say 2 crores, so you'll end up raising 6 crores. You've already diluted 60% of your company, right? So you undervalued yourself. Go and raise capital at Series A. you will not succeed. Why? Because Series A investors are investing in the team. If the team doesn't have majority stake, a substantial majority stake at Series A, you are not the right team for them, irrespective of the quality of the team and the quality of the business plan. So therefore, as entrepreneurs, it's extremely important for you to work with good investors, smart investors who mature, to make sure that your valuation is not made as the key criteria for you to raise funds at that time. Make sure you get the right partners and the right amount of funding. So what is most important is get the right amount of funding and the right partner. You need the right investor to be with, who actually can add value beyond funds, can bring Series A investor to you, take you to the next level and scale you up. So let me stop here for a minute, because I'm sure there are lots of questions here, and let me hear some questions and so that I can try and address those. Any questions here? Yeah.
So can you clarify the technicalities in pre-money and post-money valuation?
Can you clarify the technicalities of the pre-money and the post-money? So basically, if I'm coming as an investor, right, and I'll give you a very basic example. Let's say I'm putting 30 crores to take a 30% stake in the company. So the pre-money valuation for me is 70 crores. So I'm putting 30 crores over and above 70 crores. The post-money valuation is 100 crores. So basically the pre-money valuation is the valuation before my money comes in. And the post-money valuation is the valuation after my money has come. So that's the difference between pre-money and post-money. The right thing to measure is, typically, especially when you're doing an exit, people get confused. There is an enterprise value, there is an equity value. If somebody comes and says the valuation of your company is 1,000 crores, so many times entrepreneurs get very excited that they start immediately opening up their calculators and I own 20% of the company, so therefore my stake is now 200 crores. So they start celebrating even before knowing what is the actual value they'll get. Because suddenly they see that 500 crores is debt in the company. So if 500 crores debt in the company, your equity value is only 500 crores. Right? So effectively, the investor it's very important to ask the question to the investor. Is it the enterprise value or is it the equity value? The enterprise value is the value of the equity and debt put together. And most of the time when an investor offers you a valuation, it's the valuation of it's the enterprise value. So there is debt in your business, then that is typically already factored in by the investor. Right? Does it make sense? Okay, any other question?
So you mentioned about team playing a big role in valuation, and now investors have come up with when we approach investors, they come up with what IP do you have? Since we are a product-based company, sir, so we keep on changing the product, upgrading the product. So does IP really play a big role?
So everybody's understood that question? Let me repeat and just tell me if I got it right. So he's saying that team, what role does team play, and for the IP, how much value does IP hold in the valuation of the business, right? So that's
product gets upgraded every quarter or half year.
Especially if it's a technology product, right? Yeah, so I think IP is actually effectively in a product company, it's all about IP, right? Or if it is a story about distribution, you may not have an IP, but you have a product where your strength lies in branding and marketing, right? So, if product is your strength, if you believe that your product is unique and you own the IP of the product, right? It's a tech product, then you have to be able to justify in your story that this product can generate so much revenue, and you have to keep upgrading your product. In technology, you have to keep upgrading your product. So in a technology product company, it's all about IP and how well you're able to protect that IP, right? So somebody can come tomorrow and claim first of all this is my IP, this is not even your IP. That also can happen, right? So have you protected that IP is the first question. How protectable is that IP in the first place? Can you file a patent on it? Is it patentable? If it is not patentable, how are you really looking at positioning this product? How do what if somebody else comes and just copies that product? So there are lots of those questions, right? So therefore, it also translates to the combination of the product IP and the execution ability of the team. So therefore, how good the team is in terms of selling the product. Are they targeting the right customer segments? Are they pricing it right? Are they with the right go-to-market strategy? So there are lots of other components beyond IP itself. Make sense?
So, in a manufacturing company, so valuation mainly is done on the basis of the assets and on the revenues and market size that the company is going to capture. So, what all are the other factors that can be brought in for valuing the company?
So, in a manufacturing company, the company could be valued based on the assets, is what you're saying.
Plus, what else can be the factors?
So, you have to keep in mind one thing, and I remember, talking to, for example, certain hospitals when I was trying to, value hospitals, for example, the valuation hospitals. So, once I remember I was talking to a 200-bed hospital in Gurgaon, in the heart of Gurgaon. And when I looked at the revenues and projections, this guy, I came up with a valuation of over 150 crores for the business. And this guy started laughing. He said, my land and building is 200 crores. So what are you talking about? You're telling me that, my business is at 150 crores, I can sell my land and building at 200 crores. See, the thing is that you have to first decide what business are you in. And what is the core part of your business? Now, one can argue that land and building is a core part of the business. But, when you look at, it's about the cash flows of the business, the balance sheet versus the P&L. The valuation is a function of your cash flows, your future cash flows. Ideally, if you own those assets, whether it's real estate or plant and machinery, your cash flow should be able to capture that over a period of time. Which means that if you did not own those assets, you would have been either renting it, right, or outsourcing it to someone else. There will be an additional cost, which will have an impact on your cash flows. Your cash flows will come down. Similarly for the hospital. Now, if his land and property is a part of it, and he's not paying rent to himself. So in his business plan, effectively he's saying that, look, I don't have a rent item. But if you put a rent item in the heart of Gurgaon, that will actually be a substantial cost item for a property of that size. And when you do valuation, you will either do that rental part, assuming that the property you have to separate out first, because the property is a separate asset which is being used by the hospital. So therefore, it will have a cash flow impact. So effectively, the cash flows over a period of time is what will determine, or you can look at some of these notional assets and how they actually impact your cash flows. You can always factor in is the valuation of the asset. If he's saying 200 crores, first of all, it does not necessarily mean it's 200 crores. Because when you actually go to the market, market may not want to buy it more than 100 crores because the actual rental value of that might be just 2 crores per annum. So that is the case, then what's your justification that the valuation is 200 crores? So therefore, from a valuation perspective, you always look at all the operating expenses and look at the cash flows, and then do a benchmark based on a discounted cash flow method, and then look at various other measures in terms of the multiples of revenues and other things, right? So, and then compare the multiple factors that go into evaluating or assessing the valuation.
How much is it like? What are the multiples? Normally, what are the average multiples?
The multiples depend on the businesses, and the multiples vary on 2-3 factors. One, it varies on the growth of the business. How the business is growing. Is it month on month, quarter on quarter, year on year? And the second factor is the profitability factor. So in terms of so eventually it has to translate to the actual margins. So different businesses will have different growth factors. A tech business, for example, a B2B SaaS business, for example. Freshdesk as an example, which got listed on NASDAQ recently. On a $125 million ARR, they were net profit of $70 million. Right? So a SaaS business, interesting thing about a SaaS business is that it is repeat business.
Margins are high.
It is repeat business. The cost don't go up as much as, because software product you make once, more and more people keep using it. Every time someone uses it, the cost doesn't go up as much. So your revenues increase, but your costs don't increase. That's why SaaS business gets a much higher multiple. And I've seen multiples of starting from 10x going up to 40, 50x also. Right? So it's really, one can argue that look at the size of the market, therefore how, my scale would be very, very non-linear. And I've seen businesses getting 40x, 50x also on the revenue, annual revenue. So, and on the other hand, a business which is a services business, where it's a consulting business, it's a people business. The revenue is based on the number of hours you spend. So, even if you have 1,000 people team, every time your business grows, you need more people. Right? Unless you build those many hours, your revenue doesn't go up. So the multiple is very low. Because your revenue is based on, and every time you increase your revenue, you have to add more cost. So therefore the revenues are dependent on these factors, or the multiples are dependent on these factors. Any other question? Yeah.
Sir, this is not a question, but I just want a vetting of my thought from your side. I really don't agree that new startups, which are just 1 or 2 years old, their valuation, some of the smart VC funds try to do based on the book value. While my thought is that initially, like in my case, I spent my initial 2 years only on building my model. I never ran after business, or I never focused much on the business development, because I wanted to develop my products, my sourcing, my model, and I did a testing kind of model. But I was not behind money that time, because my infrastructure was not perfect, and the whole products were not ready. I did 3-4 changes in my product. So after 2 years, I have reached to that stage where I am ready to expand in a big way if I get the money. I went to an institutional VC fund of a government, and they were trying to do the valuation based on the book value. So in fact, they offered me also sizable sum, good amount, but they were asking for more equity from my side. And it was pre-COVID time, so I politely regretted them that I think maybe this is not the right time, I take your funds. So is my thought right or wrong, sir?
So as I said, the first thing, right? Talk to the right investor. So, the first question anybody would ask is, were you talking to the investor who could understand your business model, right? If they're not able to understand your business model, they will do all kinds of things, and if they don't understand, they will just try to lowball it as much as possible. They don't want to take any risk with their capital. So, and there are investors out there, and in today's market, I can tell you that any business you have, and that's where I believe that, especially in the Northeast, where obviously there are not too many VCs right now, I believe there's a huge potential, is because, entrepreneurs are not able to communicate properly, they're not able to go to the right investor in the first place. And here, if you go to local investors here, for example, who have never done these kind of investments, even if you go to an investor who is actually coming with or a debt kind of a mindset, right? Very hard to even show them your vision, right? So they will always look at a balance sheet and say, your current assets are not justifying, etc. So do your research on the nature of investor that you need to first of all meet with. Because there are enough number of investors out there who will understand your story. Basically, they need to believe in you as a person and a team, and they are betting on you, right? And that's the fundamental thing. As long as you talk to the right investor, they will listen to your story, they will value your story, and they will give you value for your future projections. So my only conclusion on that, what you're telling me, is that you are probably not talking to the right investor. So that is my, because you understand your business very well. Maybe you know, you may have also communicated it the way you should have communicated. But whether the investor understood what you were saying is very important. So do a complete analysis of who are the investors out in the market. And even the angel investors, there are multiple platforms. You know, you have, you talk about CIO angel networks, there's Indian Angels Network, there's Mumbai Angels. Name a city and put Angels Network after that. There's an angel network these days. So there are professional angels everywhere. So, and take the right guidance. Get a right mentor with you. Somebody who has done deals, somebody who has been there and that. That person will be able to guide you properly. In the first place, tell you what should be your story, how you should, you know, tell your story, and who you should tell your story to. That is very important. Make sense?
Right.
Yeah.
I have a question.
Yeah. No, but people
So my metric is on customer lifetime value. That's one of my very key metrics. And the product that I sell basically is falls under the D2C category. The challenge that I'm facing right now is this is based on my experience. So I have closed about close to 300 plus investments so far in the last 9 months. I had an opportunity to present to 26 investors which was live. And about 5 investments I went to round 3 without their founders. The challenge that I'm facing is that the whole concept of B2C, which is direct to consumer, and especially on the food side, somehow they don't understand there is difference between farm to fork and a D2C model, number one. And secondly, what most of the big players are doing right now, they are also looking at an opportunity to put the omni-channel, which is typically offline. So, which we anyways are doing it now. That's where the business will go. So my question to you is that, since my metric is CLV, do you have investors who will go for a valuation? Because that's what they look at. When I'm giving my pitch, they look at my valuation of the company, which is 9 months. When they ask me this question, I tell them right now I have 9 months data. My CLV right now at this point in time for customer is about 900 rupees. Right? It fluctuates between 600 to 900. And I have a population that I'm sitting at today, which consumes non-veg at the age of 4 till the time the person dies. Which is the average age of about 60 to 70. So that's my population base. And that's the span of that's happening in non-veg in a zone like this. And if I put that in here, obviously my percentage is going to be lesser because we have vegetarian, vegan, and non-veg. Will this be a critical part to add on to a valuation when they look at the forecasting of my business? Because I'm still a concept level as what my market fit product right now. I've done my MVP and now I'm fully scale.
So before I answer that, Gaurav, how much time do I have? Very last question. Yeah. So, I think fundamentally, your projections of the future cash flows is based on the assumptions that you're making. Right? Your assumptions are linked to your sizing of the market. You're sizing the market. Your first fundamental thing is that here's the size of the market that I'm targeting. Here is the other players in the market, and therefore this is the kind of market share I will acquire, and this is the kind of customers I'm going to go after. And this customer segment is going to consume my product, and it's going to consume over this period of time, and that will be derived from the time, right? Now there are various assumptions as part of that whole story, right? So some of the assumptions, what you're not necessarily maybe counting in that assumption is that there could be a competing product in the same market at a much better price, bringing much better technology or differentiated technology, bringing maybe a newer way of marketing or distribution, right? So some of these factors, so unless in your execution of the business, it is demonstrated that you will always stay ahead of the market. Even if your competitor comes, either you have the ability to acquire them, or stay ahead of the curve by doing certain things. And you've demonstrated at least some part of that, either in your previous experience in life, or in your team somebody has done that, or even in your pitch if you mention that, I'm aware of this, and this is my strategy to deal with it. There's a certain question the investors don't ask you. And some of these questions are linked to the execution and, your assessment or your assumptions that you make about this specific market you're going after with your product and the competition and the pricing. Lots of these things, while you may be communicating with them, they may be asking certain questions, but based on your responses, they may not necessarily be asking any further questions because your responses may not have been comprehensive in addressing those questions. So I think it's great that you've actually met, you said 36 investors. So the best thing about doing that is that every time you meet an investor, there's a learning experience, right? So every investor gives you some feedback, you go back, you incorporate, do further research, go to your next pitch with better informed, so how to answer that question. In 36 presentations, I can tell you that you would have become an extremely smart entrepreneur as compared to someone.
1 million of reached now, so let's see how it goes.
Exactly. So that's the point I'm trying to make. So in fact, Robin Hood is an example, a classical example. They got rejected 76 times. 76 times before they got their first check, right? And they became a multi-billion-dollar company, right? So as long as you believe in yourself, as long as you know what you're doing, and in those 76 pitches, every pitch would have taught them something new, and they would have fine-tuned their model further. So I think my only thing is that maybe there are still questions which are not answered. In your case, those 36 investors, the 36th investor has not still understood. But that's okay. I think as long as you believe in it, and by now, I hope that you would have come to some kind of a structure that you can now take to the investor and say, I do understand that you may not necessarily understand all these things, but hey, I have a structure for you which you might like. Why don't we work together and figure out something together? Right? So I'll be able to justify something going forward. So I think that's the way I would handle it. So I think I know that I've run out of time, so thank you so much for having me here. I think I'm available in general, so please feel free to ask any questions otherwise. Thank you so much for your time. Thanks, Gautam.